Hey everybody, I'm Pete Carmasino here at Chaikin Analytics. This is our halftime show on StockCharts TV. Each and every week, we kind of go over the markets and what's happening there, sort of in the beginning of the video. Just talk about the macro view. So much to talk about. The markets today really give us sort of an unending amount of content. And interestingly enough, I understand it's obviously sort of financial, not Armageddon, but certainly not a fun type of financial commentary here. But the idea is just to be aware of the risks and make sure that you can make changes along the way, protect yourself. We've been talking about this for months. So hopefully you've been tuning in and listening. If you're new, thanks for tuning in, and we'll go over some setups that we have been talking about, what has worked in the past, and sort of, again, from a macro view, we're going to look at the dollar, we're going to look at interest rates, we're going to look at some index levels. And then each and every week, we obviously go over the power gauge, which is part of the ACP platform. You can buy it as a plugin. It's really inexpensive. And it shows you sort of a fundamental rating and a technical overlay. But the fundamentals are really about 85% of the rating. So it's nice. It's a nice tool to add to the ACP platform, just because ACP is pretty much technical. And we've got an unlimited amount of technical tools there. When you add the rating on top of it, it kind of helps smooth out the idea of, is this name continuing further because of bad fundamentals and bad technicals, or just technicals? And sometimes you'll see the correlation. What I like to do is kind of go over our own way of screening and kind of introduce some ideas that you might consider and look at, and why they're setting up the way they're setting up, and then obviously how they correlate to the power gauge. So we're going to do that as well. But first, we're going to dive into, again, what's happening here in the markets, which is, obviously very volatile. And again, if you've been tuning in to me or listening or reading anything I write, for a long time now, you understand that we've been talking about this downtrend for quite some time. And so the path of least resistance is still lower, and that's okay as long as we understand what's happening. We did have a bit of a rally here in the beginning of the day, and now we're kind of rolling over slightly. Not giving it up yet, but it's early. It's only, I'm recording this right around noon. But by the time you see this, it'll be 1:15 or later. And U.S. equities are mostly lower. And obviously that's due to change sort of in the next couple of minutes here, or a couple of hours for sure. But what you're seeing is just, the indexes are down off their best levels right now. So let's dive into the charts and take a look at what's setting up. But first, let's go over sort of the macro view of the market. All right, everybody, look, we've got a lot of Fed speak this week. It's kind of amazing that there are 22 different, I don't know if it's 22 different speakers, but it's really 22 different incidents of Fed speak. That's probably a better way to say it. But, they're doing what they have to do, right? Whether we like it or not. Instead of complaining, I hear a lot of talking heads, talking from academic type talking heads down to, folks that are actually practitioners and running money, sort of complaining about the Fed. I mean, look, the Fed has been telling us this for a long time. We knew they were going to be doing this, right? That's how they fight inflation. It's part of their mandate. And obviously the toolbox is not they don't have 100 different tools in there. The way they're doing it, they're going about it, try to be data dependent. But some people are saying they should anticipate slowing inflation. Well, if they didn't anticipate rising inflation, it's pretty hard for them to anticipate slowing inflation. Now, I get it. Prices are down. I'm not defending the Fed. All I'm saying is that we're in this together, right? We've already gone through where we're at. Here we are today. So let's move forward and see how we sort of position ourselves and make sure that we're not sort of missing anything in all of the narrative and sort of the thematic way people are looking at this. Because look, I really do believe there is some, what's the word really? It's a bias, right? An opinion and a dogma or something that you might have formed over the last 30 or 40 years, right? Why are bonds, not rallying and supporting stocks? Well, because if you're not bullish on the bond market, it's really hard to be bullish on the stock market. And what I always say that, well, if bonds are moving up, rates are moving down. That's the way it works. And that's not happening. Rates are moving higher because bond prices are falling, and they're falling in tandem with stocks. And so until that correlation corrects itself, there's going to be a level. We just don't know what it is, but we're going to go over interest rates as well. Don't think we're not. We're going to look at some charts. We're going to look at some interest rate charts and obviously the TLT, which is sort of the barometer. But bonds got crushed. I mean, that's what's happening. Interest rates are powerful. They affect currencies. Look what happened to Japan and South Korea. Overnight, it was the United Kingdom. They're dealing with that particular situation because when rates rise, it creates a strong U.S. dollar, and the U.S. dollar is like a wrecking ball, right? It is really going through asset by asset. Obviously, bonds, tech stocks, we already know about that, and just stocks in general are under major pressure. Who's going to be next on the currency side? I don't know. I just think that it's really going to be affecting all currencies, and if it hasn't already, at what degree is hard to know. And that's really what is kind of what's happening here today. So I think what's happening is sentiment is obviously being diminished, right? That's obvious, right? If we look at the AAII reading, and I'll show it to you today, it's really at one of the 5 worst readings on the bearish level since 1987. That's unbelievable. So let's take a look at what's going on here in the markets. There's our S&P charts right here. You can see the laser pointer. You've got discretionary, communications, and technology here right in a row, obviously under pressure. We knew that. We knew that going into this. That's what happens when rates rise. But everything else is under pressure too. So you've got to be careful and take a certain degree of risk. And maybe no risk at all. Cash at this particular point may be a little late, but it's still not out of the question. But again, it just depends on your risk tolerance and your time frame, and where the assets are. There's so many factors that go into it. Obviously, you have to consult a professional and make those decisions, hopefully with a good some good guidance there. Let's look at the dollar chart. So I got the dollar chart here. Let me advance. How about if I advance the screen? So here's the US dollar chart and the upside target. Now, this is just a target based off of sort of Fibonacci extensions and kind of finding, the high and the low and where things have kind of sort of measured up. That's pretty high. If we see a 120 or a 121 on the DXY here on the US dollar, boy, that's going to be pretty damaging in a lot of ways. Let's hope we don't, but unfortunately, that's the trend we're seeing. You can see down here is the US 10-year ramping up, and obviously I had crude oil in here just because we know it affects commodities, and it is pressuring oil to the downside as well. So you are seeing sort of a ripple effect. This dollar is, again, like I said, a wrecking ball in a lot of areas. So let's go here to the next slide. So I'm just looking at the S&P. We did some patterns. As a matter of fact, we talked about this last week. This level here was 4,300. A lot of people are saying, oh, look, the 200-day did its job. It did, for sure. I think it was a coincidence. I really do think it was a neckline here that was formed by this head and shoulders pattern that was really more important. The 200-day just happened to get in the way. So 4,100 was another level that was kind of testing and sort of became support and resistance, and it wasn't exactly sure. It did it a few times here, but it ultimately got down to our target. Now, this is the 29th of August, okay? So let's move to the next slide here. The 12th, we're seeing obviously rebounded right back to 4,100, and then obviously right back down again here. That was last week's chart, and kind of here we are today. Now, I drew this line here, this 3382, and I expanded it. It is around that pre-pandemic high, and so there is sort of some confluence there of, again, a head and shoulders pattern that's projected lower, and obviously the pre-pandemic high. So take it for what it's worth. It's just a technical pattern. I'm looking at some long-term trends, right? Here's September 26th from a monthly long-term. This is 1975 back here. If I go 75, I find it somewhere in the mid-80s, and then I find the 2008 crash, and obviously, continue on, right? It looks pretty dire, right? If we get down to that level, I don't think we're going to see that. I zoomed in a little bit to show really the trend line from the 2008 crisis. There's the pandemic, and here we are now. Now that's about 3,000. That's a little lower than I was talking about, 3382. But you're seeing estimates in these areas. I think this is why. I think long-term trends come into play. I think in general, that's what markets test no matter what. But I think you're seeing a lot of folks sort of using that as a forecasting method. I love the bullish percent chart. If you guys follow me, you know that. I'm just seeing the bullish percent rollover again in the S&P, the NASDAQ 100, and obviously in the New York Composite. The rallies are getting a little bit, less impactful. But the average rally here, if you saw, was about 13% or so. But we really never got rally 4. It's kind of the headline of that chart is where is rally for? It just didn't happen. It didn't happen yet, but we'll have to see. There's the FANG index. This is from August 1st. It was around 5,500 or so. And here it is last week at about 5,000, just about that 5,100, and just lower again at 48. Now, we're probably going to take out the lows here and, the recent lows, and probably get back to this pre-pandemic high. I don't know that for sure. It's just the way the trend's going, but I'm just calling it out. Here's the big news, I think. Look at this bearish sentiment indicator. Truth be told, this is used as a contrarian indicator, meaning that if there's too many bears, that's bullish. If there's too many bulls, that's bearish. We are not seeing that play out. We saw several weeks in a row of bears way above the historical averages. How about double this past week? And if you read this, it says this is one of the 5 highest bearish sentiment readings in the survey's history going back to 1987. So take that for what it's worth. We'll keep it there. I'm talking about rates because, I write a morning note. We kind of changed some things around here at Chaikin, but when I was writing this back in May, we had a target of around 3.5 to 375, right? On the 10-year interest rate, U.S. Treasury rate. June 14th, we got really close, around 349 or so, as you can see, and it backed off. June 24th, you can see the rollover getting back to the previous levels. The 27th was starting to kind of just migrate and kind of, sort of meander on a sideways trend. And obviously, here we are today. That was September 23rd. That was Friday's close at around 369, right inside that target, right inside the time frame that we were kind of looking at. And obviously, that bodes negative for bonds. That's what we've been saying, to avoid bonds for a very long time now. This entire year, we've been calling it out because of higher interest rates. And so you got to keep that in perspective. There's TLT. We were talking about a $100 target. There it was last week. Here it is today. The $100 is still a target on the TLT, just because we're seeing just, confidence, I think, in the longer term bonds. And obviously, the trend is against them. And with rates moving higher, it's just not going to help the cause. There's your S&P. We had a 375 target on it. We drew some trend lines along the way there in July. That was during the rally, right? We were talking about it. It came right back to where we showed on the previous charts, but rolled over last week. And here we are today, this morning. I took this probably around 11:30 or so. We're just seeing it roll over again and potentially getting down to that level, that 3,400, 3,380 level that we talked about. Qs, same thing. No different on this chart at all. And, here we are today, just rolling over. All right. As I like to remind you, you can follow me on Twitter. This is my handle at Pete Carmasino. That's my page. And I said I'm going to look at some charts here on the downside. 2 names popped up, both in the capital markets industry or sector, so to speak. And what I have is Ares Capital. You can see, you can get a little indication here. This is our platform, obviously not the ACP platform, but this is called a business development company. And obviously there's some different ways you can view those types of companies. But look, they're in the capital markets. But this was just, had some trend higher here during that rally, but has rolled over, testing its lows, if not there already. And obviously in a bearish area, definitely oversold, but Chaikin money flow getting worse and that relative strength changing to the downside. That's really how I found this one. That's the alert that I kind of look for in these names. The other one is Main Street Capital. And Main Street Capital is sort of a name that is obviously in that capital markets area as well. Another business development company. And don't forget, a lot of people use these for yield, and they try to find areas of yield in the market based off of different types of companies, things of that nature. My point being is, don't chase the yield. When you have a stock that can move from 45 down to 35 in less than a month or 2 months, what good is the yield, no matter how high it is? Right? It could be losing principal. So point being is, both of these names are in the same area, and we've got a new relative strength change to the downside. That's something you got to be careful of when you see that. All right, everybody, that's all we have for today. Thanks for tuning in. I really appreciate the time. Leaving, obviously, a like here on the video, but we'll be back next week. Thanks again. This is Pete Carmasino, Chaikin Analytics. Take care.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.